Where is my money? Tell me where. You wanna chit chat, but I don't care. Can't be playing with my cash, no way. This disrespect can't be the play. Why you playing games with my cash? Owe me big, but you're acting rash. Said you pay me back today. Hey, now you're silent like it's all okay. Cash rules everything around me. Everything. Pay me what you owe, don't flee. Pay me. Dusty promises, don't sue. No dusty promises. Gotta get straight to the loot. See you styling in your new threads. Spending freely while my wallet's dead. You think I won't come for my green, but I'm not backing down from this scene. Where's my money? You promised me. Where's my money? Quit the chatter and just agree. Where's my money? Your lies ain't funny, it's getting old. Pay me now before I get bold. Where's my money? Dusty excuses won't get you far. Up in the club buying out the bar. Time to face up, you owe a debt. Avoiding me won't let you forget. Ducking calls like a ghost in the night. Running scared, but I'm ready to fight. No more stalling, it's time to pay. Running out on me is not okay. Where's my money? You promised me. Where's my money? Quit the chatter and just agree. Where's my money? Your lies ain't funny, it's getting old. Pay me now before I get bold. Where's my money? Cash rules everything around me. Everything. Pay me what you owe, don't flee. Pay me. Dusty promises, don't sue. No dusty promises. Gotta get straight to the loot. To the loot. Everything around me, everything. Pay me what you owe, don't flee. Pay me. Dusty promises, don't sue. Dusty promises. Gotta get straight to the loop, to the loop.
Welcome back, welcome back, welcome back to another Saturday morning episode of Our Men Lie. Women, they also lie. And numbers, what the hell do numbers do? Numbers don't lie, y'all. Numbers, they just manipulate. We are going to review our weekly economic numbers, our weekly economic indicators. We're going to bring tech and the economy together, see how we are all affected. It has been a crazy past couple of weeks. And then we end up just about where we were 2 weeks ago. It is what it is. It is what it is. Let me get this banner up for today's show as we jump into it. Hopefully everyone is doing phenomenal. Hopefully you had an amazing week as well. Shout out to all of you out there. Where is my banner? Hold on. There we go. Perfect. There we go. Weekly Tech Times Economics Review. I am Techo Trough. We are engineered to win. Today is Saturday, April 12th, 2025. We are zooming through the month of April. I am excited. I'm always looking towards the future. I am always looking towards growth. So that is where we're headed. All right. Let's see. Quick announcements for this morning. That would be, we're going to be going live tomorrow for DevOps. I should be having a sprint review with my tech barbarians tomorrow. That is available to everybody who is in the Patreon to join in and see what we're going to be doing. You can join in live. You can ask questions to my tech barbarians to see what they were working on. And we're going to have our normal scheduled candid conversations on Monday, all of that good stuff. So stay tuned, stay on the lookout. TechCoDrop.dev, like, share, subscribe. Also, the next album is coming out on Tuesday, April 15th, on tax day, 2025, called Frenemies. And I know I said when I released the Victory album on Christmas Day that I love that album, which I do. But then I said that Abandoned might be my favorite album of all time. Well, now that Frenemies is coming out and I was listening to it the other day, I was like, man, this album is so good. It is a different style from the Abandoned album, which was all fun. And I mean, Abandoned was like a very, very emotional type album. This one is just going to be such a fun, inspiring, encouraging album. You know how we do over here. So that is where we're headed. All right. Other announcements other than that, I think that's about it. I think that is about it. So we can get our show on the road. I'm not going to be here forever. Let me put up our hour and a half timer because it is a busy weekend. It's one of my busier weekends. So going to try to keep everything in line, keep everything moving. And might have some people come do some work here today. So we shall see. The night is young. We shall find out. All right. But with that being said, let me say good morning to those in the chat and those who are watching from the clouds or the shadows or the bushes. Good morning to you all. And I'm going to start off with my guy over here, Wave Nerd, says good morning. Good morning to you, Wave Nerd. How are you doing? Hopefully your week was phenomenal. Looking forward to talking to you a lot more in the future. All right, with that being said, we are going to jump into our show. So the first thing that I want to do a quick look at is we're going to take a look at, where is this? We're going to take a quick look at the stock market real quick because I know there were a lot of people who had these strong heart palpitations. They were like, oh my God, what's going on with the stock market? I'm losing so much money. I'm like, did you take money out? No, but I can't take the stress that I'm losing so much money that I have lost so much unrealized. I have so much unrealized loss. I'm like, why are you dying over unrealized losses? Like, shouldn't you wait until they're actually realized? Like, if it's down, then don't take money out, So, but I wanted to check it out, see how we're doing. Looking at we're gonna look at a couple of big ones and the Dow, the S&P, all of that good stuff, right? So let's go ahead and switch over. So let's see how this market is actually doing. All right, let's zoom in a bit. So the Dow Jones is at 40,212 when, what was it? I think at the end of last week, Friday, like a week ago, it was at 38 maybe? I don't know. Let's take a look. So if we look at a 5-day period on, what day was it? April 7th. What day was April 7th? April 7th was, what day? Let me see. Where's my calendar? Let me take a look. What day was April 7th? April 7th was was Monday. So on Monday, the Dow was at 37,000 and it closed the week at 40. So if we go, let's do a month. Can we do a custom range? I don't know. Let's see. Let's do a month average because I'm just curious, right? So all right. So let's take a look at the beginning of April. It was at 42 April 2nd, 38 April 4th, 37 April 8th, and then it went to 40. So about 2,000 down from April 2nd to April 11th. And it was like hovering around 42 for like between 42 and 43 that whole time. So if we look at April 3rd to April 11th, people were going crazy because the craziness started happening about last week, Thursday, Friday. They were going crazy, crazy, crazy. Oh my God, the world is burning. The world is burning. Just to end up exactly around where we're at over a week ago. All right. So how about that? So much hysterics, so much craziness, and we are just back to where we were before. All right, let's take a look at the S&P. How did the S&P do? So people were going crazy about the S&P as well. Same time range. It was April 3rd, 5,396, and now it is at 5,363. I mean, you know, it's just about the same thing, but people were going absolutely crazy. Oh my, we're going to go jump off the building because our unrealized capital, so much unrealized capital gains were lost and then they were returned. So if your gains were realized, then that's on you. Bruh. All right. Anyhow, I wonder how the Asian market is doing though. Let's see. Asia's doing about the same thing as well. No, I'm still looking at this S&P. Hold on. How can I see Asia? Is this the one for Asia? Let's see. Let's take a month look at Asia. Not that I know anything about the Asian market, but I'm just curious. 34. Not much of a difference. I don't know. I don't know anything about Asian markets, but I'm just curious to see how in similarity the U.S. market and the like what was happening in the U.S. with the impact it had on Asia. Europe, just throw that in there for a second. Doesn't look like much happening over there either. Not that I know these markets at all, but you know. Anyways, I was just curious through all the hysterics that were happening, how the market actually looked, and it looks exactly the same as it was about 10 days ago. So, you know, it is what it is. It is what it is. I don't follow the market that closely because, as they say, dollar cost averaging, all of that. You know what? Let me see how NVIDIA is doing. NVIDIA over the past, let's see, month, we use April 3rd, 101, closed higher than it was April 3rd. Let me see. Now I'm just looking at the ones that I have. Let me see. How's Tesla doing? How's my Tesla? Let's see. Tesla. 5 days, or let's go a month. Actually, Tesla's up over the past month. Imagine that. Imagine that. All the hysterics that are happening around Tesla, and they're actually up over the past month. Who would have thunk it? Let's see, 6 months. Tesla's all right. Now I'm a little confused. Because people are supposed to be getting rid of their Teslas. They're supposed to be burning them down. People are doing vandalism. And over the past 6 months, Tesla is also up. Maybe I'm missing something. How about year to date? Year to date, though, Tesla is down from the beginning. Okay, over the 6 months, they're up, but year to date, they're down. It is what it is. Over the past year, though, they are up. Over the past 5 years, over the past 5 years, Tesla is up 560%. I don't know. I just don't know. Anyways, just want to do a quick, let me check Google as well. How about Google? I think it's this one that we're supposed to check. Google over the past 6 months. Google is down a little bit. 1 month, still a little down. Year to date, down. 1 year, down. Google's been actually down recently. How about Amazon? This is very, very selfishly. I'm checking all these right now because I don't follow this stuff on a daily basis. I just throw the money in there and like let it do what it's gonna do with these top companies. Amazon is actually down a little as well. Up over the past 5 days, down over the past 6 months, year to date down. Over the past year, they're also down just a little bit though. Anyways, I just wanted to do all right, one more. Microsoft. How's Microsoft doing? Microsoft is down year to date, down 6 months, up 1 month. Let's see. Okay, cool. All right. Anyways, that check is done. We are ready to move on to looking at our first topic for today. All right, so let's get to it. All right. Wave Nerd says Nokia for the future bet. Let me see how Nokia is. Let me see how Nokia is looking. Do you have any insight of what Nokia? Because I haven't heard anything from Nokia in a long time. What is Nokia up to? Let me see. Is there an American Nokia? New York Stock and Nokia. Let me see. Nokia is a pretty cheap stock. Maybe we do some research on that. Maybe we'll do some research on Nokia. But yeah, cool. All right. Let's get into our show for today. All right. The first thing that we are going to do is go to our Urban Dictionary of Economic Data, and then we will go through, for today, we have our FOMC meeting minutes. We have our, let me go switch over to the screen. So we're going to be looking into today the FOMC meeting minutes from Wednesday. Then we're going to be looking at the CPI, which is talking about inflation. So if you didn't know, inflation went down just a little bit, right? And then we're going to be looking at our PPI, Producer Price Index, and then we will finish up with the Consumer Sentiment Index from the University of Michigan, if it actually works for us, all right? So that is the plan. Let's jump into it. Let's start off with our FOMC meeting minutes, all right? So I'm going to do a search for FOMC. FOMC stands for Federal Open Market Committee. Basically, those are the people who make monetary policy for us here in the United States. Let's see. Let's click into that. And let's read about what it is. And then we will do a search for we'll figure it out as we get there, right? But the report for FOMC Open Market Committee. The FOMC is a group of quote unquote important people from the Federal Reserve, which is like the USA's bank for banks. They meet to decide things about money, interest rates to help keep the economy running smoothly, allegedly. They make sure their goal is to make sure prices don't go too high. That's called inflation. Keep people working by helping businesses grow. So when they say make sure that prices don't go too high, and that's called inflation, is it the prices going too high that is the actual inflation, or is it the printing of money that makes the value of the dollar depreciate that is the inflation? Does the price go high? Does the price of the brick go up because we are devaluing the money and that's what's causing the inflation? Or is it just because what if businesses decided to arbitrarily raise their prices, right? Does that make it inflation, or is it because there's so much money in circulation that is causing the inflation? That's the question, right? The their second goal is to keep people working by helping businesses grow. I don't know how well they do any of these points, all right? Because inflation was at over 10% at one point, from my understanding. It says, what happens when the FOMC releases meeting minutes? The meeting minutes are like notes from a big class meeting showing what was discussed. They tell us what the FOMC thinks about the economy, like whether it's doing well or needs help, if interest rates might go up or down in the future. This affects things like cars, mortgages, and credit card payments, plans for inflation control. They share if they're worried about prices going up too fast. So what should we expect from the FOMC meeting minutes? It says if the notes suggest the economy is slowing down, they might lower interest rates. This makes borrowing money cheaper so people and businesses can spend more. If the notes suggest the economy is too hot, the block is hot. The block is hot. With prices rising fast, they might raise interest rates. This makes borrowing harder, which slows things down to prevent inflation. We should also stop printing money. and spending more as a country than we have. That would also be helpful. When the minutes are released, investors and businesses pay close attention to figure out what might happen to the economy and plan ahead. All right, so let's get a custom example of how the FOMC meeting minutes would relate to our everyday lives. So let's say that someone is a custom mobile, or not custom, but let's just say they're a mobile app developer. How does the FOMC meeting minutes affect the mobile app developer? And by the way, Wave Nerd, this web application that you see here, we built it maybe we're in April, maybe in August, September, October, sometime in that time range. We built it in order to help us look up these definitions, and then we added this AI component to get custom examples of how the report that we pull up is applicable to that position, right? So let's see. It says so. Let's see how the FOMC actions can impact a mobile app developer. Interest rates and funding. Interest rates, if the FOMC decides to lower interest rates, it becomes cheaper to borrow money. For a mobile app developer, this means that they could take out a loan to expand their business or invest in a new feature for their apps without paying a lot in interest. Impact. The developer can hire more workers, invest in better technology, or market their app more effectively because they have access to cheaper money. This can lead to growth in their user base and revenue. User spending. Lower interest rates can also influence how much money people have to spend. When borrowing money is cheaper, consumers may feel more comfortable spending money. If potential users feel financially stable, they might be more willing to purchase apps or spend on in-app purchases. The impact. More spending can lead to higher sales for the app developer. If the user feels they have extra money, they're more likely to buy a premium version of an app or pay for additional features. I'm telling you, whenever they give you these options, they're like, oh, you can get this or that. You want to go for the highest one. Be like, oh, that's a lot of money. I don't know, but if you have extra money and the features are actually worth it that you get for the higher version, then you might go for it. All right. So, summary: when the FOMC makes decisions that affect interest rates, it can have a direct ripple effect on how much money mobile app developers can borrow to invest and how much consumers are willing to spend on their apps. Lower interest rates can help developers grow their businesses and increase sales, while higher rates might have the opposite effect. So the FOMC might seem far removed from the daily activities of an app developer, but their decisions can have real implications for business operations and consumer behavior. All right, so let's go to the FOMC calendar real quick. And we are in this one, released April 9th. Let's take a look at here. And let me see, this is really, really long. What I'm gonna do, I'm gonna copy this URL right here, all right? And we're gonna take it to the web page summarizer that we built and you see how everything comes together? What we did in the large language models course, we're going to use that web page summarizer to summarize the FOMC meetings. The last time we used this web page summarizer was last month for our FOMC meeting, all right? So we're going to take that. We're going to say, what is it called? Display summary. We're going to pass that URL, enter. And boom, there we have it. We have a summary of the monetary policy from the meeting minutes set by the meeting minutes set by the Federal Open Market Committee. So let's read that, because we're not going to read that whole long meeting minutes, right? So let's read a summary that our AI web page summarizer that we built on the morning show created for us, right? So The Federal Reserve, as the central bank of the United States, strives to maintain a safe, flexible, and stable monetary and financial system. This website focuses on monetary policy oversight and updates regarding the Federal Open Chair Market Committee, which plays a pivotal role in influencing monetary policy. So here, the key areas that are covered in the release minutes is an overview of the Federal Reserve's monetary policies, principles, and practices, FOMC meetings, information about the meeting minutes, agenda, yada, 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 and the economic conditions. So the recent announcements as of March of 2025, FOMC meeting minutes. The FOMC decided to maintain the target range for the federal funds at 4.25 to 4.5% amidst elevated inflation concerns while noting ongoing growth. Participants expressed heightened uncertainty concerning economic conditions and the balance of risk to inflation and employment. A resolution on the pace of the balance sheet reduction was deliberated, resulting in a planned reduction of Treasury securities monthly redemption cap from $25 billion to $5 billion. The economic outlook. The Federal Reserve anticipates inflation to remain above 2% target in the near term due to influences like tariffs. The Fed remains committed to achieving maximum employment while managing inflation expectations. Overall, the content emphasizes ongoing economic assessments, monetary policy strategies, and their implications on market activities alongside the Federal Reserve's commitment to adapt policies based on evolving economic indicators. All right. So that's basically what the meeting minutes were saying in that we summarized. Let's see. So what we are going to do, I have a video about this. So we're going to watch that together. And then we will carry on. So we're going to go over here. And let's watch this together.
Right now, though, our focus goes to the latest Fed minutes, and we do have them crossing, so that means off to Mike McKee at the Federal Reserve. Mike.
Well, facing an economy that was slowing but still growing with sticky inflation and a relatively solid labor market, it's no surprise that Fed officials spent most of their March 19th meeting discussing tariffs. Stagflation was on their mind with, quote, almost all participants viewing risks to inflation as tilted to the upside and risks to employment tilted to the downside. Several noted the planned tariff increases were larger than their business contacts had anticipated, and some companies were already reporting tariff-related price increases. Contacts also indicated a willingness to pass those price increases along to consumers. A couple of the participants noted it could be difficult to determine whether inflation was caused by persistent price rises or by tariffs. The labor market remained strong through the middle of March, but federal government layoffs had begun to affect employment at contractors, universities, hospitals, and other organizations. Many participants noted that business survey respondents to them reported pausing hiring because of elevated policy uncertainty. Everything considered, participants felt the net effect of government policies on the economic outlook was high, making it appropriate to take a cautious approach. And given the current state of policy and stance of policy, the Fed was well positioned, they said, to wait for more clarity on the outlook, though some observed they might face difficult trade-offs if inflation proved to be more persistent while the outlook for growth and employment weakened. On the balance sheet, although Fed Governor Christopher Waller was the only one to vote against a slowing of the balance sheet runoff, the minute shows several participants said they did not see a compelling case for a slowdown. There's no indication whether the participants felt that this would be a permanent move or a temporary move. Guys?
I'm talking. I'm muted. So that was pretty much a summary from Bloomberg about the FOMC meeting minutes. The rates stayed the same. All of that. So I mean, the one thing that I don't understand with all of this media hysteria about tariffs, if the tariffs are such a bad pain point and it's going to hurt us, why are all these other countries running to, like, why are they running to get rid of these tariffs, right? If it hurts us as badly as the media makes it seem, why are countries like, you know what, we're gonna drop our tariffs, we want to make a deal? Why are they doing that? Why wouldn't they just want to hurt us? If it's gonna hurt us, why do they want to make a deal? I don't know. You know, like if tariffs hurt us as Americans, and we put tariffs on China, why did China raise their tariffs on us? Shouldn't they say, okay, shouldn't they like, all right, cool, put your tariffs. It's only going to hurt you guys anyways. Has anybody asked that question? If it is so bad for us, why do other countries not want us to impose it if it's hurting us? So does that mean then the countries putting the tariffs on us are hurting themselves? But when we put the tariffs on them to hurt us, they're like, no, you cannot do that. That's not fair. But if it's hurting us, then why do you care? Maybe I'm asking too many questions. I am asking too many questions. All right, that is it for the FOMC meeting minutes. We are going to dive next into the consumer price index to take a look at inflation. But I'm going to check the chat real quick to see what we got going on. Wave Nerd also said about Nokia, says they own the air rights. Oh, interesting. I'm going to have to look that up. Let me make a note to myself. Note to self. Let me text myself, actually. Look into Nokia. All right. Note to self to look into Nokia. All right. And then we have Rock, the Scrubs, Roxy in the building, says good morning, Techodrop, and everyone. Good morning to you as well. Roxy, how are you doing today? Hopefully everything is going well with you. And Wavener says the media is the enemy. I would love to disagree with you, Wave Nerd, but I can't. I agree with you. This is what the media does to us, right? This is what the media does. They say that the world is burning. They tell you, like, it could be a beautiful day outside. They're going to tell you the world is burning all around you, all right? And you look outside, you say, I don't see anything burning. You're like, no, it is burning all around you. And then you start to believe them that the world is burning. And then so now you're acting like the world is burning, and then they say, "You see, look at the craziness that's going on. They are we told you, like, they're acting like the world is burning, when everything is actually okay. It's like maybe it's not perfect, but the world is not burning, right? But they feed you what they want you to believe, and then they react to you believing what they tell you. It is a mess.
Congratulations. You played yourself.
It's crazy out there. Wayne there also says your platform would be a great product for government policy makers. I don't know about that. I would say something, and then my federal worker friends, they would come after me. They would be like, they're going to come after me anyways, because I'm going to get into DOGE watch at the end of the show. That's how we wrap up the show. But I don't know. I try to be on different lanes with the federal government, because I tell you, they are feisty. They are feisty. All right. Anyways, let's jump over to our consumer price index for today. All right, we're gonna go over to here, and we're gonna go over to here. All right. CPI, Consumer Price Index. What is the Consumer Price Index? At least Wave Nerd, they would be educated. They would be educated by this platform. All right, so the Consumer Price Index, it is like a price report card for everyday things that you buy, like groceries, gas, clothes, and even rent. Imagine you make a shopping list of all the stuff you need. The CPI keeps track of how much that list costs over time. Here's how it works. Shopping baskets. Think of it as a big basket filled with all the stuff people usually buy. So that's like your cereal, your meat, your vegetables, your toothpaste, your garbage bags, whatever it is. It's just everything, and they try to measure that price. They compare today's price with prices from the past to see if things are getting more expensive or cheaper. It says if the CPI, if the price of the brick, consider CPI, Consumer Price Index, as the brick, right? If the price of the brick CPI goes up, it means prices are rising and your money doesn't stretch as far. If it goes down, things are getting cheaper. So if whatever it is that you buy, it's like, let's say you used to buy for $10, right? But it's no longer $10. Now it's like $15. The price of the brick has just went up. All right. So all right. So it says, why does it matter? Well, it affects how much money you will need to live and how much you can save. It also influences things like wages, pensions, and even the economy. Basically, CPI is a way to measure the cost of living and how it changes over time. Let's use a job role of let's use a therapist. How does the CPI affect the therapist? So, examples of impact. So it's a useful tool for understanding inflation, which can impact various industries, including mental health services. Example impact on a therapist: fee adjustment. So if your therapy bills go up, it might be due to inflation. So let's say a therapist charges $100 per session. If the CPI shows that inflation has caused the cost of living to rise by 3%, the therapist might consider raising their fees to $103 per session to keep up with increased costs of rent, utilities, and other operating expenses. So if their rent goes up, if their electricity bill goes up, if the price of food goes up, let's say the therapist has coffee in their waiting room, right? But the cost of your Nespresso coffee pod thingies, the little discs, that went up. Let's say it used to be like for $100, they can get it for like $30, but now for $100, it's like $40. That means the cost of the brick has just gone up. Meaning that your dealer, your therapist, has to pass the cost over onto you, because guess what? That's $20 more that they have to budget, and that way, and that $3 extra that you're paying per session, that, and you know, therapists don't do per session, they do per half hour. So it's like you're paying like $200 per half hour. So you go in there for an hour just to share all your thoughts and your feelings and your emotions. And they say, you know what? I just thought about this. It's like you're paying $400 an hour to have someone listen to your problems and be your friend. It just popped into my mind, right? Some people need it. I mean, some people need it, of course, but that's basically what it turns down into, right? I don't know. I could be wrong. Please don't come at me. Please do not come at me for what I just said, all right? I'll just cut it from the show. It says, all right, so income and affordability. If clients are facing higher prices in their everyday lives due to inflation, as reflected by the CPI, they may have less disposable income. This could lead to some clients reduce the number of therapy sessions they attend to seek alternatives, which could directly affect their therapist income. So they're basically, if they're trying to charge you more money, right? You're like, well, I'm just gonna reduce my sessions. It's kind of like when you used to work full time, and now they say, well, the companies have to offer every single employee full-time, like insurance and benefits and everything like that. So now the company says, you know, we're just going to reduce your hours to 29 hours a week so that you cannot be considered full-time. We don't have to give you all these extra benefits, right? So now you're missing out. That's another form of inflation. So what it's saying here is if the price goes up, then you might cut down on your sessions or find alternative ways to get your therapy, which is going to affect the income of the therapist. And I would say, alternative, start jujitsu, right? I'm just saying. All right, budgeting and resources. Therapists often need to purchase supplies, pay for continuing education, or subscribe to professional services, as Wavener was just saying, license fees, like software for scheduling. If the CPI indicates rising costs in their area, they might need to adjust their budget accordingly to ensure that they can still provide quality services. Understanding client concerns. As general living expenses rise, clients might come to therapy with increased stress related to financial issues or opportunities. A therapist who understands how inflation influences their clients' lives can better tailor their approach to address these concerns. In summary, the CPI affects a therapist's practice by influencing fees, client affordability, budgeting for expenses, and understanding client stressors. This makes it an important factor for therapists to consider in their professional planning, right? So the funny thing is, when we pass it through this, it gives you so much idea. Because I was like, how does the inflation affect a therapist? And then it says, oh, well, the amount that they charge their clients, the amount for their fees, like the stuff that they have to buy, and then pass that along through their clients. So what inflation really boils down to is when the business has a cost, it all ends up getting to the consumer anyways, you know? All right. So let's go ahead and take a look at this report, which is brought to us by the Bureau of Labor Statistics. Let's see. So the latest numbers, consumer price index dropped by 0.1%. I mean, it seems like it's nothing, but apparently it's a big deal to all the financial people, you know? So let's take a look. So the consumer price index for all urban consumers decreased 0.1% on a seasonally adjusted basis in March after rising 0.2% in February. So they were going, oh my God, inflation rose in February, but then in March it dropped by 0.1%. So net over the past 2 months, we still have a 0.1% increase. Says the Bureau of Labor Statistics reported today, over the last 12 months, all items index increased 2.4% before seasonal adjustment. Let's see, the index for energy fell 2.4% in March as a 6.3% decline in the index for gasoline. Index for all items less food and energy rose 0.1% in March, following a 0.2% increase in February. Let me see, let me zoom out a little bit. Okay. The index for airline fares, motor vehicle insurance, that decreased in March. All items index rose 2.4% for the 12 months ending in March after rising 2.8% over the past 12 months. All items less food and energy index rose 2.8% over the last 12 months, the smallest 12-month increase since March of 2021. All right, let's see. So if we look at this, all items, it dropped by 0.1%, but for food at home rose by 0.4%, for food away from home rose by 0.5%, energy rose by 0.4%, energy commodities though dropped by 2.4%, gasoline dropped by 6.1%, fuel and oil dropped by 6.3%, and if these prices continue to drop, then our energy bill should get a lot cheaper, hopefully. You never know. Electricity, it went up by 1.6%. Let's see, utility pipe gas, 3.6. Wait, electricity is at 0.9. Commodities, less food and energy commodities, 0.1, negative 0.1. Vehicles went up 0.1. Used car and trucks went down by 0.7. All right, cool. So that is basically our consumer price index for the month of March. Nothing in particular to dive into, but let's go ahead and take a quick look at a video where they are talking about the CPI and the implications of it going down, as little as it went down, the implications of it going down, all right? So let's go over to here. And let me get the right video up. Where is it? Where's the thing? Oh, that's right there. All right, CPI. Let's take a quick watch about CPI.
Santelli is in Chicago this morning. He is standing by at the CME. Rick, the numbers, sir.
Yes, these are March reads on the Consumer Price Index, coming in under minus 1/10 on headline, minus 1/10. We're expecting the exact opposite. We're expecting up 1/10, minus 1/10. Well, we equal where we were in May of 2020 to find a lower number. You're all the way to April of 2020, the heavy COVID-affected months of the calendar. If we take food and energy out, still coming in on the under, up 1/10. We're expecting triple that number, up 1/10. Well, that would equal where we were in June of last year. To find a lower number would be 0 in January of 21. These are definitely low numbers. Now, let's look at year-over-year perspective, shall we? Up 2.4, we're expecting 2.6. 2.4 would equal where we were in SEPA 24. You have to go to Feb of 21 to find a lower number. Now let's go year over year. Ex food and energy, expecting 3, comes in light 2.8. That follows 3.1. 2.8 would be lowest since March of 21. These are really low numbers. Now let's look at initial and continuing claims, shall we? On the initial claims, we're looking for a number that would be roughly in the 224 camp, comes in at 223, very close to expectations. And if we look at the continuing claims, last month they reached 1.903 million, and once again they revised it away. 1,893,000 is last month, and the new number 1,850,000. That really is a nice drop. And if we want to comp, the last time we were at that level, well, it would be the last week of January when we were under 1.84. So that would be your comp. You could see yields haven't moved under in a dramatic way, but I will say there's a bit of irony here considering all the tariff stories on inflation. To see these numbers coming in light for March, well, it's somewhat enlightening. Now, let's go to Steve Leisman for some thoughts as he peruses some of these data points. Steve?
Yeah, Rick, thanks. I'm looking at here this core goods number, which the Fed had flagged as something that they were worried about, which was perhaps a pop that you saw in prior months because of front running on tariffs. That came back and was well behaved. If you look at the commodities, ex-food and energy core goods, it resumed a negative downward move. Nice help on vehicle insurance was down 0.8%, at least on the month. It's up quite a bit. And you did not get, you went the other way on the owner's equivalent rent, 0.4, not as bad as it had been. You had some pop up in food prices, 1%, 1.3%, and you got an awful lot of help from energy this time around. The key here is going to be, well, this may be the calm before the storm, a lot like the employment numbers. Do you have higher inflation numbers coming through because of some of the tariffs that are out there? Real quickly on the tariffs, the market seems to think it got a lot of relief, and maybe it did. Maybe there's a change in stance of President Trump. But I'm reading a lot of the dismal scientists that say, you know what? There might have been a lot less there than you think. Average tariffs in the country are still very high, even after that relief, much higher than 10%. Wells Fargo just sent me a note. They say the average tariff in America is 27%. I'm seeing numbers 23, 22, and they're still predicting negative numbers on GDP and surges in inflation from the existing tariffs, unless they go away, Andrew, from negotiation. To you, Andrew.
All right, so that was, they actually spoke a little bit more. They spoke about the consumer price index. They spoke about the initial jobless claims and the continuing jobless claims, and you know, it's pretty much at expectations, right? So that wraps that one up for us. So let's go ahead and put a bow on that, and we're gonna go back and check the chat before we get into our next topic. So. Let's see. Wave Nerd said that they, meaning the federal government, hate automation. I'll tell you this, Wave Nerd. As someone who I'm a QA engineer, I've been writing I've been testing using automation tests since 2011, right? And the amount of people who says like they don't want to learn automation. And then they also say automation is going to take our jobs. For me, I'm like, well, if automation is going to take my job, let me learn how to do automation so that I can be the one controlling the automation and I don't have to lose my job, right? But do you remember the dock workers strike that was going to happen last year? A big part of the strike, and I think I released a clip from that Q&A show just recently, but a big part of the strike was because they didn't want robotics, they didn't want automation. For me, when I think about robotics, when I think about automation, I'm like, wow, we can do a lot more with less. So that means we can have more companies, more businesses producing a lot more out there, and we're using 21st century technology, robots, AI, automation to help more people do with less. And when more people, I think the sentiment that a lot of people have is like, oh well, we can't be innovative. We can't open more business. We can't create more stuff. So therefore, jobs are going to get replaced. For me, I'm like, well, that means that there's going to be more jobs created with higher skills needed to know how to control all these different tools and stuff like that, right? So that's just throwing that in there. Wavener says the license fees. Yep, that is true for the therapist. All right, cool, perfect. All right, let's zoom through the show because very, very busy day today. Let's go back to our dictionary. And what do we have next up on our docket? I'm not going to get into the initial jobless claims. It's 223. It was expected at 220. It was forecasted at 223. It's actual 223. Last time it was 219. We know the initial jobless claims are people who are asking for help from being unemployed for the first time. No need to jump into that again. Let's go and take a look at our producer price index. But price. So that is also known. Wait on. Producer price index. All right, there you go. PPI. It's also brought to us by the Bureau of Labor Statistics, the same people who brought us the consumer price index. But what exactly is the producer price index? So the producer price index is similar to the consumer price index, but instead of tracking the price of things people buy, it tracks the price that people pay to make those things. So here's how it works. The producer price index, so production costs. Imagine a factory making sneakers. They need material like rubber, fabrics, and labor. So let's say a factory making Jordans, right? They need materials like rubber, fabric, and labor. The producer price index tracks the price of these materials and services. So they track the price of how much it costs for rubber, how much it costs for the fabric, how much it costs for the labor. So pricing, just like the CPI, the consumer price index, the government checks the prices of these materials and services regularly. They compare the prices. They compare today's price with the price from the past to see if the cost for businesses are going up or down. If the PPI goes up, it means the cost for business to produce goods and services are rising. If it goes down, it means those costs are decreasing. So why does it matter? When the production cost goes up, businesses might raise their prices to cover these costs, which can eventually lead to higher prices for consumers. So PPI can be an early indicator of inflation, showing how the prices of raw material and productions might affect the prices we pay in stores later on. And I said this before in the past. If you see the cost to produce is going up, the cost to purchase is going to follow maybe 2 months, 3 months, 6 months down the road. So for me, I think as a consumer, I would be looking at the producer price index to anticipate what's going to be happening in the next X amount of. So I'm going to say for the career, who is normally in charge of, I'm going to look for a stay at home homeschooling mother, because they're looking for deals to keep the family costs low and stuff like that. So I think that the producer price index would greatly help a stay-at-home mom, which is like the homemaker, but we're gonna say homeschooling stay-at-home mom. Let's see if the producer price index would be helpful for a homeschooling stay-at-home mom. So it says, all right, so examples for how the producer price index would affect a homeschooling stay-at-home mom. So let's say the homeschooling mom needs to buy textbooks, workbooks, and educational software for her children. If the PPI, the producer price index increases, it could mean that producers of these materials are raising their prices. As a result, she might find that the cost of buying new educational resources is higher than it was before. This would impact her budget since she may have to allocate more money for these supplies, or she may need to look for cheaper alternatives, which could affect the quality of her children's education. Groceries and snacks. Another aspect is food. If the PPI for food rises, it means that food producers are charging more for groceries. Since homeschooling often takes place at home, families may consume more snacks, meals, and other groceries. This increase in food prices can strain the family overall budget, making it more challenging to plan meals or stick to a grocery list. The mom might have to rethink her shopping strategy, possibly opting for more budget-friendly options or planning meals around sales and discounts. So let me read the last one. Let me read the last one, and then I'll share some thoughts on this one, right? Finally, the PPI, if the PPI is rising, producer price index, it could impact the overall economy, leading to inflation. If prices go up for many goods and services, that may affect the family's financial situation if the dad or partner has a fixed income that doesn't rise at the same rate. The mom may have to adjust her homeschooling plans based on available resources, ensuring she gets the most value while keeping quality education and family well-being in mind. So in summary, the PPI can impact a homeschooling stay-at-home mom by influencing the cost of educational materials, groceries, and overall budgeting for the family. Keeping an eye on trends in the PPI can help make informed choices about spending and resource management, right? So and here's the point that I was making earlier. If they are tracking the PPI, they're just anticipating what the CPI is going to be in the future. Because normally with the PPI being high, you don't see that in the CPI until a trailing month, 2-3 months, depending on the lead time for the supplies, right? It is possible that the businesses already start to raise their rate because like the CPI can already start to go up based on the availability of items, but that's a toss-up, right? All right, so let's get into the PPI report. So PPI for final demand decreases 0.4 in March, goods decline 0.9, services fall 0.2. Well, it is getting cheaper for stuff, apparently. So this is a good sign for future CPI and inflation because like I was saying, if the PPI is going down, the CPI should eventually go down at some point, all right? Says the producer price index for final demand decreased 0.4% in March, seasonally adjusted to the U.S. Bureau of Labor Statistics reported today. Final demand prices increased 0.1% in February and 0.6% in January. On an unadjusted basis, the index for final demand advanced 2.7 for the 12 months ending in March. In March, over 70% of the decrease in the index for final demand can be traced to prices for final demand goods, which fell 0.9%. The index for final demand services declined 0.2%. Let's see. The prices for final demand less food, energy, and trade services edged up 0.1% in March after increasing 0.4% in each of the previous 3 months. For the 12 months ended in March, the index for final demand less food, energy, and trade services advanced 2.4%. Let's see, final demand, it moved down by 0.9%. Final demand is like the goods in their final form that you're going to be buying. It's like, I sell at the producer level because you haven't got it from the store yet, but it is to produce the final outlook packaging of whatever you're going to be buying, all right? Product detail. 2/3 of March decline in index for final demand good can be traced to 11.1% drop in prices for gasoline. So shout out to the gas prices going down. Drill, baby, drill. The index for chicken, eggs, beef and veal, chicken, fresh and dry vegetables, diesel fuel, and jet fuel also moved lower. Conversely, price for steel mills products increased 7.1%. The indexes for residential, electric power, and for processed young chickens also advanced. Final demand services. Prices for final demand services fell 2.2% in March, the largest decline since moving down 2.2% in July 2024. Leading the March decrease, margins for final demand trade services dropped 0.7%. Trade indexes are measured in margins received by wholesalers and retailers. Let's see. Product detail for vehicles. Those are also on the decline. All right. And there goes a chart of everything. Let's see. And intermediate goods are what it takes to, like the different components that it takes to make the final demand product. The prices for processed goods for intermediate demand were unchanged in March at 0.4% increase in February. In March, a 0.9% rise in goods for the processed foods and feeds, which fell at 3.2% and 0.5% respectively. Let's see. I think that's it. I think that is it for the producer price index. All right. So let's go ahead and let's watch a video on the producer price index. Do we have a video on the producer price index? Let me see. Yes, we do. This is the one. All right, so let's watch this one.
We're just seconds away right now from March PPI data. I want to get straight over to Rick Santelli. He is standing by at the CME in Chicago. Rickster, the numbers.
Yes, these are our March read on producer price index, the more wholesale side of the inflation equation, and they're big numbers, down 0.4 on headline, down 0.4. That would be equal to where we were in October of 23. And if we find a lower number, you're going all the way back to April of 2020 in the COVID-affected era, and that was down 1.2%. Now let's strip out food and energy, down 0.1%. That equals where we were in February. It equals where we were in July. To find a lower number, you're in April of 2020 at -0.3. If we look at ex-food, energy, and trade, it is up 0.1, also much less than we were expecting. Up 0.1 equals where we were in November of last year. To find a bigger, smaller negative number, you're -0.8 in April of 2020. Now let's look at year-over-year final demand. 2.7, well below our expectations of 3.3, well below 3.2 in the rearview mirror. To find a lower number, you're in September of last year. So we see that this metric had been moving up. Now it's moving back down. If we look at food and energy from a year-over-year perspective, 3.3, less than 3.4 in the rearview mirror, less than 3.6 expected. That equals September of last year. To find a lower number, you're in August of last year at 2.8, and drumroll please, the last metric of this PPI data series, year-over-year ex-food, ex-energy, ex-trade, 3.4, the only metric higher than we were expecting by 0.1, higher than the rearview mirror by 0.1. 3.4 equals where we were in January. To find a higher number, you're in Dec of last year at 3.5. Late revisions coming in on headline. Last month's 0 on the final demand headline now moves to a positive 0.1, and it's now -0.4. That means the net change is 0.5% lower, and on the ex-food and energy month-over-month, -0.1 becomes positive 0.1. So the net change is down 0.2 because the current number is down 0.1. Maybe the biggest thing that should jump out at anybody is that last week, the 2-year note yield closed, get this, at 366. It's at 383. A 10-year closed at 4% last week. It's at 4.42, up 42 basis points. Think about the ramification. We're at 60 on the 2-10 spread. Now, everybody's hair's on fire for all the uncertainty. I understand it. Hearing all the guests say this is the biggest move they've ever seen in treasuries and whatever. Well, that's because we had thin markets and very thin hours where we had extremes. Then the market comes into our own time zone. You populate that with much more trading. Here's the only thing that I look at. I like to keep it simple, folks, and let's keep the emotions down. The high yield close for the year in 2s, okay, that was at 438 on the 13th of January. So that, we could see, has a flight to quality, flight to safety feature built in, maybe a Fed component built in. Now, let's go up the curve. On the 14th of January, a 10-year closed at 479. A 30-year closed at 498. Those closing yields are above where we're at now. So if the world is so bad and treasuries are expressing everything's on fire, why can't we get a higher yield close on the year versus where we were in January? Those are numbers we should pay attention to. Back to you.
All right. So that was our producer price index. Like I said, it looks like, looking at the numbers, right? We do know that the numbers certainly manipulate. But if we're looking at the numbers for ourselves, it looks like prices should be coming down. It looks like the prices that they should be coming down. Will they? There's no guarantee, but they should be coming down. And we didn't have to pass any laws on price gouging as our federal laws on price gouging as our major initiatives. All right. So with that being said, we're going to, let me see anything. Wave Nerd had said a homeschool teacher. Shout out to that. That's basically what we used. All right, let's go over to the University of Michigan Consumer Price Index. All right, so let me see, Consumer Sentiment Index, not Consumer Price or Survey. Sentiment. So the University of Michigan Consumer Sentiment Index. The University of Michigan Consumer Sentiment Index is a survey that asks people how they feel about the economy. It gathers information about what people think about their current financial situation, how they feel about spending money, and what they expect for the future. The survey results are combined into an index, which is like a score that shows whether people feel positive, negative, or neutral about the economy. This index is important because it helps people understand how confident people are about spending money. When people feel good about the economy and their own financial situation, they are more likely to buy things like food or clothes, not food. They're always going to buy food, but clothes, gadgets, and cars, which helps businesses grow and create jobs. If the index shows that people are worried they might spend less, which can slow down the economy. Economists and government officials use this information to make decisions about things like interest rates and economic policies, helping them support a healthy economy. So let's search for. Ooh, I have one. Let's search for a. Say charge nurse. So a charge nurse in a hospital, for instance, there would be the head nurse in charge, the HNIC. Yes, the head nurse in charge is who the charge nurse is. Okay, it says. So it says. Why is consumer sentiment important for healthcare? In healthcare, particularly in roles like a charge nurse, understanding consumer sentiment can have various impacts. Here's how. Examples of impacts for a charge nurse. So patient volume and admissions. High consumer sentiment. If the University of Michigan Consumer Sentiment Index shows high consumer confidence, it might indicate that people are more willing to spend money on healthcare services. This could lead to an increase in patient volume and elective procedures, meaning a charge nurse may have more patients to manage and will need to ensure the staff is adequately prepared. Low consumer sentiment, on the other hand, says consumers. Conversely, if the index is low, patients may delay non-emergency care, leading to fewer admissions. This could mean the charge nurse has to adjust staffing schedules and resources due to the decrease in patient care. Budget and resources. High levels of consumer confidence often reflect positively on hospital funding and budget allocation, as more patients can lead to higher revenue. For the charge nurse, this might translate to better resources like new equipment or more staff, which can improve patient care. In a situation where consumer sentiment is declining, the charge nurse may need to be more resourceful and possibly manage with limited supplies and staff due to budget cuts. Lastly, patient care approach. When consumer sentiment is high, patients may come in with a more positive outlook that may be more engaged in their healthcare decisions. A charge nurse would notice this and could foster a collaborative atmosphere. If the sentiment is low, then the patients don't care. They may be anxious or less cooperative, so the charge nurse may need to implement additional emotional support strategies and communications to address these concerns. All right. So basically, the way that would affect the charge nurse would be affect the charge nurse's environment by influencing patient volume, budget decisions, and overall patient attitudes towards care. So understanding these trends can help the charge nurse prepare and adapt to provide the best care possible in varying economic climates. All right, so let's jump over to this report, which I'm pretty sure this is not going to work. Nope, it never works. So let's search for University of Michigan Consumer Sentiment. If we click on this, there we go. All right, let's take a look at the consumer sentiment. So according to our Urban Dictionary of Economic Data, to our weekly economic indicators, let me filter this. The expectations for April for our first indication, it was expected to be at 50.8, but it was actually at, well, let's do the sentiment first, right? It was expected at 54, it's actually at 50.8. So the consumers are not feeling too optimistic about the economy. And the future is even worse, all right? It's even worse. I can't blame them though, because if every day you wake up, you turn on the news and say, "Oh, the world is burning, the world is burning, the world is burning," you're not going to be happy about hearing the world burn around you. Okay, so that to me, I think the media drives a big portion of consumer sentiment, because you might see that your prices in gas are going down, your food prices are going down, you're getting a raise, but the media tells you that, oh, but what about your 401k? You're like, oh my God, just throw everything out the window. My 401k, I have so much unrealized capital gains, I don't know what to do with myself. So that happens as well. So let's go ahead and take a look at this. For April, it is currently at 50.8 for current economic conditions. So current economic conditions is at 56.5, but the consumer expectations is at 47.2. All right, so let's see what this has to say. It says consumer sentiment fell for the fourth straight month, plunging 11% from March. This decline was, like last month's, pervasive and unanimous across age, income, education, geographic region, and political affiliation. Has any of you ever been selected for a actual survey? I've never been selected for a survey that I know of. Sentiment has now lost more than 30% since December 2024, amid growing worries about trade war developments that have oscillated through the course of the year. Let's see. Consumer report multiple warning signs that raise the risk of recession. Expectations for business conditions, personal finances, incomes, inflation, and labor markets all continue to deteriorate this month. The share of consumers expecting unemployment to rise in the year ahead increased to the 5th consecutive month and is now more than double the November 2024 reading and the highest since 2009. This lack of labor market confidence lies in the sharp contrast of the past several years when robust spending was supported firmly by strong labor markets and incomes. Note the interviews for this release were conducted between March 25th and April 8th, closing prior to April 9th tariff partial reversal. So this is how people were feeling right before the tariff reversal. So that'd be interesting to see in 2 weeks if the sentiment has changed at all for the month of April. And we might get some additional developments between these trade talks with these foreign countries. Year ahead, inflation expectations surged 5% last month to 6.7% this month. So people are expecting to have inflation. The highest reading since 1981 and marking 4 consecutive months of unusually large increases in 0.5 percentage points or more. This month's rise was seen across all 3 political affiliations. Long-term inflation expectations climbed 4.1% in March to 4.4% in April, reflecting a particularly large jump among independents. All right, so that is the University of Michigan consumer sentiment. All right, let's go back to full screen. And there you have it. There you have it. That is our consumer sentiment index. Let's see. All right. We are going to wrap up the show looking at whatever latest developments that DOGE has come out with. Let's do a little bit of DOGE watch. All right. So let me go over to the other screen. Let's see here. All right. DOGE watch. Latest work from DOGE. Good work by the USGSA, again, for inking its first consolidated deal following the president's executive orders, eliminating waste and saving taxpayer dollars by consolidating procurement. With this deal, the GSA effectively used government-wide buying leverage to secure a 71% price something. Let's see. DOGE says California, New York, and Massachusetts accounted for most of these 3 improper claims, totaling $305 million in unemployment benefits. That's a lot of money. That is a lot of money. Additionally, California accounted for 68% of unemployment benefits paid to parolees identified by CBP, or by parolees identified by CBP on the terrorist watch list or with criminal, maybe record. Let's see. Anything else? So it says an initial survey of unemployment insurance claims since 2020 revealed that the following: 24.5 thousand people over 115 years old claimed $59 million in benefits. 28,000 people between the ages of 1 and 5 years old they claimed $254 million in benefits. 9.7 people with birth dates over 15 years in the future claimed. That is interesting. Okay. Anything else? We'll stop at this one. On the website, the login button was not on the top right of the nav bar like it is on most websites. It was weirdly placed in the middle of the page. An IRS engineer explained that the soonest this change could be deployed was in July. What the son of a... Oh my God. So you're telling me to change this position of this button to over here, like it is here, that would take 3 months to do. You see, and this is why. This is why when they're like, oh my God, they're taking our jobs away, our federal jobs, and then you see, well, you're saying that in order to change this one button, moving the placement, it would take 3 months when I can go in there and do it in like 30 minutes. I can do it in 30 minutes. That is crazy. That is absolutely ludicrous. And that's why I'd be like, we don't believe y'all. We don't believe y'all when y'all like, oh, we work so hard. okay, I need you to change this button. Okay, you'll get it in July. You're like, July? What the? Is that for Independence Day that we're changing this button? It does not work like that. It does not work like that. All right, let's see. What else? Anything else? Let's see. I think that's everything. I think that is everything for today. We will continue on next week. I'm gonna end our Doge watch. And that is it for today. That is it. We are ahead of time and under budget. I have some things that I have to go take care of. So I thank you guys so much for tuning in. Wave Nerd, shout out to Wave. Oops, what did I just do? Ooh, oh, okay, that's good. Let's see. I pressed something by mistake. There we go. All right, cool. So let's go to check the chat and then we're gonna get out of here. We have, let me see. Winger says, software contracts is the biggest scam for government workers. They contract to their friends and kids. That is a fact. Bruh. That's a fact. Last week I read on one that said that, and this is the scam that you're talking about, right? I read one that said they said that they were paying $350,000 a month, $350,000 a month to a web development firm, right, to make minimal updates on a site. I forgot which agency it was. It might have been the IRS. I forgot which one it was, right? And then what happens is they get a in-house developer now. They cancel the contract. They get an in-house developer to make the changes, which is they spend about 10 hours a week, if that much, making the changes internally. They found somebody who's already working for the agency. And now that's just part of their responsibilities to make these changes 10 hours a week. Is it 10 hours a week or 10 hours a month? I think it's 10 hours a month, actually. I think the changes are 10 hours a month, right? 10 hours a month. And so now we're going from over $1 million spent to making these updates is just part of this web developer's daily task, which is 10 hours a month. It is crazy that the amount of money that we're wasting, all right? Anyways, it's just crazy, right? Wave Nerd said Obamacare website was the site that crashed as soon as it launched was $4.1 billion for a website. A website is 4.1. That is absolutely crazy. That is absolutely crazy. 4.1 billion. All right. With that being said, I have to end it here because I'm gonna catch something. All right. 4.1 billion for the Obamacare website. Say it ain't so. Say it ain't so. That is crazy. But we're gonna get out of here. I'm gonna check. I cannot check it on stream because you're gonna see me get so upset. All right. So I'm gonna check it after the stream so I can get upset privately. All right. But that's it for today. Thank you guys so much for tuning in. Shout out to you, Wave Nerd. Shout out to you, Roxy. Shout out to everybody watching from the clouds. You guys are all the best.
We the best.
And I'm going to wrap it up. Let's see. Quick announcements. Tomorrow, DevOps. We're going to continue working on Kubernetes. Most likely, we're going to do a Scrum night tomorrow night with my Tech Barbarians. That is available in the Patreon as well as in the Team Tech Drop Discord to see what we've been working on. We had to do a major pivot this week because of some things that came up. So we're going to be talking about that. But yeah, that's about it. That is about it. Remember, Frenemies album drops on Tuesday. You definitely want to check it out. It's going to be on Spotify, Apple Music, YouTube Music, Amazon Music, wherever you get your music from, it's going to be available. That is currently my favorite album. So that's where we're going to go, right? But that's it for today. Thank you guys so much for tuning in. This is let me move this out the way before I close it out. Let's go with that. Okay, all right. This is Tech Coach Ralph with another episode of Men Lie. Women, they also lie, but numbers just manipulate. And that with that being said, we are out.
Where is my money? Tell me where. You wanna chit chat, but I don't care. Can't be playing with my cash, no way. This disrespect can't be the play. Why you playing games with my cash? Owe me big, but you're acting rash. Said you pay me back today. Hey, now you're silent like it's all okay. Cash rules everything around me. Everything. Pay me what you owe, don't flee. Pay me. Dusty promises, don't sue. No dusty promises. Gotta get straight to the loot. See you styling in your new threads. Spending freely while my wallet's dead. You think I won't come for my green, but I'm not backing down from this scene. Where's my money? You promised me. Where's my money? Quit the chatter and just agree. Where's my money? Your lies ain't funny, it's getting old. Pay me now before I get bold. Where's my money? Dusty excuses won't get you far. Up in the club, buying out the bar. Time to face up, you owe a debt. Avoiding me won't let you forget. Ducking calls like a ghost in the night. Running scared, but I'm ready to fight. No more stalling, it's time to pay. Running out on me is not okay. Where's my money? You promised me. Where's my money? Quit the chatter and just agree. Where's my money? Your lies ain't funny, it's getting old. Pay me now before I get bold. Where's my money? Cash rules everything around me. Everything. Pay me what you owe, don't flee. Pay me. Dusty promises, don't sue. No dusty promises. Gotta get straight to the loot. To the loot. Everything around me, everything. Pay me what you owe, don't flee. Pay me. Dusty promises, don't sue. Dusty promises. Gotta